Something changed last week. Not in the usual way markets shift from day to day, not in the noise of headlines or the chatter of social media. Something deeper, something structural. If you hold silver, or if you've been watching precious metals for any length of time, what happened in Shanghai should make you sit up and pay attention. Not with panic, not with wild optimism, but with the kind of calm awareness that separates disciplined investors from the crowd. This isn't about getting rich overnight. It's about understanding what happens when decades of monetary policy meet the hard realities of physical supply. It's about recognizing patterns that have played out before in different markets under different names, but always with the same underlying forces at work. Let me walk you through what's happening, why it matters, and what it means for you, whether you're already positioned or still trying to make sense of this market. The Shanghai Futures Exchange did something remarkable. They tightened delivery requirements on silver contracts in a way that fundamentally changes the equation between paper contracts and physical metal. For years, futures exchanges around the world have operated on a simple premise. Most contracts never result in actual delivery. Traders settle in cash. Banks and institutions use these markets to hedge exposure, to speculate, to manage risk on their balance sheets. The physical metal itself rarely moves. This works beautifully when everyone trusts the system. When participants believe that if they wanted physical delivery, they could get it, that belief keeps the machine running smoothly. But Shanghai just signaled they're no longer comfortable with that assumption. The new rules require higher quality standards for deliverable silver. They've raised margin requirements. They've made it more expensive and more difficult to maintain short positions without backing them with real, available metal. This might sound technical. It is technical, but the implications are profound. Think about what a futures market really is. It's a paper representation of a physical commodity. The price discovery happens through trading contracts, most of which will never touch actual silver bars. This system works when there's abundant supply relative to demand, when the market is confident that physical metal can be sourced if needed, when the ratio between paper contracts and available inventory stays within reasonable bounds. But what happens when that ratio becomes stretched? When the number of claims on physical metal far exceeds the metal immediately available to deliver? Historically, in commodity markets, this creates tension. Sometimes that tension releases slowly, sometimes it doesn't. Shanghai's move suggests they see something in their data that concerns them. Perhaps it's the growing disconnect between Western paper markets and Eastern physical demand. Perhaps it's the inventory levels in their own warehouses. Perhaps it's the behavior of market participants trying to establish short positions without adequate physical backing. Whatever they see, they've decided to tighten the rules, to make the paper market behave more like a physical market. And that has consequences that ripple far beyond Shanghai. Let's zoom out for a moment. For more than a decade, we've lived in a world of unprecedented monetary expansion. Central banks have created trillions in new currency. Government debt has exploded across developed nations. Interest rates were suppressed to near zero, then raised rapidly, creating stress throughout the financial system. In this environment, precious metals serve a specific function. They're insurance against monetary instability. They're stores of value that exist outside the banking system. They're finite resources that cannot be created by central bank policy. This makes them both attractive to certain investors and problematic for certain institutions. Banks, particularly large commercial and investment banks, often maintain short positions in precious metals markets. Not because they're betting against gold or silver fundamentally, but because these positions hedge other exposures. They facilitate client transactions. They manage risk across complex books of business. But when physical demand begins to exceed available supply, when delivery requirements tighten, when the cost of maintaining paper shorts increases, something has to give. We saw glimpses of this in 2020 when gold briefly traded with unusual premiums between different markets. We saw it in palladium years earlier when industrial demand overwhelmed available inventory. We're seeing it now in certain corners of the silver market. The question isn't whether banks will fight back. Of course they will. The question is whether they can maintain control of a market where physical fundamentals are asserting themselves. Silver is unique among commodities. It's a monetary metal with thousands of years of history as currency. It's also an industrial metal with applications in electronics, solar panels, electric vehicles, and countless manufacturing processes. This dual nature creates unusual dynamics. When economies grow, industrial demand for silver increases. When monetary systems face stress, investment demand for silver increases. Sometimes these forces work in the same direction. Right now, they might be. On the supply side, silver production hasn't kept pace with growing demand. Most silver comes as a byproduct of mining other metals like copper, lead, and zinc. Primary silver mines are relatively rare. This means supply is somewhat inelastic. When demand surges, supply can't easily respond. Add to this the fact that above-ground stockpiles have been drawn down over decades. The massive government inventories that existed in the mid-20th century are largely gone. What remains is distributed across exchanges, private vaults, and industrial users. This creates a market that can move quickly when the balance tips. Shanghai's rule changes suggest that in their corner of the global market, that balance is tipping. We've been here before, not exactly here, but in situations where physical commodity markets diverged from paper markets, where delivery demands exceeded comfortable inventory levels, where price discovery mechanisms faced stress. In 1980, silver briefly touched $50 per ounce as the Hunt brothers attempted to corner the market. That ended badly for them, but it demonstrated how quickly silver can move when physical accumulation meets constrained supply. In 2011, silver rallied from under $20 to nearly $50 in a matter of months as investors fled to hard assets during European debt crisis concerns and continued monetary expansion following the 2008 financial crisis. Both of those episodes ended with sharp corrections. Both taught important lessons about leverage, timing, and the difference between price momentum and fundamental value. But both also demonstrated something crucial. Silver is capable of explosive moves when conditions align. When investment demand surges, when industrial users scramble to secure supply, when financial institutions find themselves caught on the wrong side of a physical delivery squeeze. The pattern is familiar. A period of suppressed prices, growing physical demand, paper markets maintaining control through futures and derivatives. Then something changes, a rule change, a default, a shortage, a shift in central bank policy. The change itself often seems small at first, but it reveals underlying stress that was already present, and that's when markets can move quickly. None of this happens in isolation from broader currency markets. The dollar has been the world's reserve currency for decades. This gives the United States unique privileges, including the ability to run persistent trade deficits and accumulate massive debt without immediate consequences. But that privilege isn't permanent. It's based on confidence, on the willingness of global actors to hold dollar-denominated assets, on the absence of compelling alternatives. We're now in an era where that confidence is being tested. Not catastrophically, not overnight, but gradually, persistently, unmistakably. China has been accumulating gold for years. Other central banks have shifted from selling gold to buying it. The BRICS nations have discussed alternative settlement systems. The global south has grown weary of dollar weaponization through sanctions. These trends matter for silver because silver exists in the same monetary ecosystem as gold. It's gold's more volatile, more accessible cousin. When confidence in fiat currency systems erodes, both metals benefit. But silver, with its smaller market and dual industrial demand, can move more dramatically. Shanghai's actions take place against this backdrop. China isn't just tightening silver market rules in isolation. They're building out yuan-denominated commodity markets. They're creating alternatives to Western financial infrastructure. They're positioning for a world where dollar dominance isn't assumed. If you understand this context, Shanghai's move looks less like a technicality and more like a chess piece being positioned. If you're already positioned in physical silver or silver-related investments, this is a moment for calm assessment, not celebration. Yes, the underlying thesis for holding silver may be strengthening. Yes, structural changes in major markets could create upward pressure on prices, but that doesn't mean the path forward will be smooth or predictable. Markets rarely move in straight lines. Even when fundamental forces are powerful, sentiment can shift rapidly. Corrections can be sharp. Volatility can be extreme. Your job isn't to predict the exact path. It's to understand whether your original reasons for holding the position remain valid. Has something changed that undermines the fundamental case? Or are the forces that led you to silver in the first place becoming more pronounced? If you bought silver as insurance against monetary instability, that risk hasn't diminished. If you bought it as a play on industrial demand meeting constrained supply, that thesis is arguably stronger. If you bought it as a diversifier in a portfolio of financial assets, it continues to serve that function. What matters now is discipline. Don't let excitement override your risk management plan. Don't abandon stop losses or position sizing principles because of bullish headlines. Don't confuse a favorable development with a guarantee. The market can remain irrational longer than you can remain solvent, as the old saying goes. Even when you're fundamentally right, timing and leverage can destroy you. Stay informed, stay patient, stay disciplined. If you're not currently positioned in silver, this is a moment for careful consideration, not impulsive action. The worst investment decisions come from fear of missing out, from seeing price movements and feeling compelled to jump in without understanding the underlying dynamics, from confusing momentum with conviction. Before you do anything, educate yourself. Understand what silver is, how it trades, what drives its price, what risks it carries, what role it might play in a diversified portfolio. Understand the difference between physical metal and paper contracts, between allocated storage and unallocated, between outright ownership and leveraged exposure through options or futures. Understand that silver is volatile. It can fall 30% as quickly as it can rise 50%. It produces no income, It sits in a vault or safe deposit box and waits. Its value is entirely dependent on what someone else will pay for it tomorrow. If after that education you decide silver deserves a place in your portfolio, the question becomes one of timing and sizing. Timing is impossible to perfect. You can dollar cost average to smooth out volatility. You can wait for pullbacks to establish positions. You can scale in gradually rather than committing all at once. Sizing is about risk tolerance. How much of your portfolio can you afford to have in a non-income producing volatile asset? For most people, precious metals might represent 5 to 10% of total assets. For some, more. For many, less. What you don't do is bet everything on a single outcome. What you don't do is use leverage to amplify exposure beyond your means to handle volatility. What you don't do is buy at the top of a spike because you saw a headline. If Shanghai's move represents a genuine shift in market structure, there will be time to position thoughtfully. If it's just noise, rushing in will cost you. One of the hardest things to accept about markets is how long things can seem stable before they change suddenly. For years, silver traded in a relatively narrow range. The paper markets maintained control. Physical demand was absorbed without significant disruption. Banks managed their exposure. Investors who predicted explosions were repeatedly disappointed. This creates a psychological trap. Observers become convinced nothing will ever change. They assume the current structure is permanent. They dismiss signs of stress as false alarms. Then something shifts. A rule change in Shanghai, an inventory draw, a supply disruption, a currency crisis, a bank failure. The shift itself might be small, but it reveals that the stability was more fragile than it appeared, that stress was building beneath the surface, that the market was one catalyst away from repricing. This is where most people make mistakes. They either dismiss the shift as meaningless because they've seen false alarms before, or they overreact, assuming the shift guarantees a certain outcome. The truth is always more nuanced. Markets are complex systems with multiple variables and feedback loops. What looks like a catalyst might fizzle. What looks like nothing might cascade. Your job as an investor isn't to predict the exact sequence. It's to understand the underlying forces, to recognize when conditions are becoming more favorable or less favorable, to adjust your positioning accordingly without abandoning discipline. This requires emotional control. It requires accepting uncertainty. It requires thinking in probabilities rather than certainties. We can't discuss precious metals without addressing interest rates. When rates are near zero, the opportunity cost of holding gold or silver is minimal. You're not giving up significant income by holding a non-yielding asset. In fact, when real rates are negative, when inflation exceeds nominal yields, precious metals become comparatively attractive. When rates rise, that calculus changes. Suddenly, you can get 4% or 5% in a treasury bill or money market fund. The opportunity cost of holding silver increases. This is one reason precious metals struggled as central banks raised rates rapidly in 2022 and 2023. Capital flowed toward yielding assets. The immediate inflation concerns that drove gold and silver higher in 2020-2021 seemed to fade. But here's what's important to understand. Real rates matter more than nominal rates. If the 10-year Treasury yields 4%, but inflation is running at 3%, your real return is only 1%. If inflation picks back up or stays persistently elevated, those nominal yields become less attractive. Moreover, the sustainability of high rates in an era of massive government debt is questionable. The U.S. government is now spending enormous sums just to service its existing debt. Every percentage point increase in rates costs hundreds of billions annually. This creates a trap for central banks. They need high rates to combat inflation and maintain currency confidence. But high rates make debt servicing unsustainable and threaten to break something in the financial system. Markets are beginning to price in the possibility that rates will have to come down eventually, not because inflation is conquered, but because the debt burden demands it. If that scenario unfolds, precious metals become interesting again, not because of crisis, but because of policy constraints and currency implications. Shanghai's move might be positioning for exactly that environment. Let me be direct about something. Everything I've described could be true, and silver could still disappoint in the near term. Markets are not logical machines that reward correct analysis on your preferred timeline. They're messy, emotional, manipulated, and unpredictable in the short run. There are powerful interests that benefit from stable, controlled precious metals prices, banks with short exposure, governments that prefer confidence in fiat currencies, financial institutions with complex derivatives, books that would face stress if metals moved violently. These entities have tools at their disposal. They can flood the market with paper contracts. They can coordinate policy statements. They can change margin requirements in their favor. They can do this for longer than seems rational or fair. This is why leverage is dangerous in this space. This is why timing trades based on single catalysts is treacherous. This is why all or nothing positions can destroy you even when you're fundamentally right. The path from here to higher silver prices, if it happens, will likely be volatile, frustrating, and filled with false starts. There will be moments when you question your thesis, moments when the crowd mocks those who hold precious metals, moments when it seems like nothing will ever change. This is normal. This is how markets work at inflection points. Your edge isn't predicting the exact moment everything shifts. Your edge is understanding the forces at work and maintaining exposure without overextending yourself. It's having the emotional strength to sit through volatility without panic selling or adding recklessly. Let's talk about the mistakes you need to avoid. Don't chase price spikes. If silver gaps up 10% on some news, that's not your signal to go all in. That's often near-term exhaustion before a pullback. Chasing momentum is how people buy tops. Don't use excessive leverage, options that expire worthless, futures contracts that force you out at the worst moment, margin loans that compound your risk. These tools have their place, but for most investors in this space, they're wealth destroyers. Don't listen to online gurus promising specific price targets on specific dates. No one knows. Anyone claiming certainty is either lying or delusional. The most respected voices in this space speak in probabilities and scenarios, not guarantees. Don't neglect other aspects of your financial life. Yes, this is an interesting moment in markets. No, it doesn't justify ignoring your emergency fund, your career, your other investments, or your risk management principles. Don't assume that because something makes sense fundamentally, it will happen on your timeline. Markets can remain disconnected from fundamentals far longer than seems possible. Patience isn't optional in this game. Don't become emotionally attached to a single outcome. If conditions change, if your thesis is proven wrong, you need to be able to adjust. Dogmatism is expensive. And perhaps most importantly, don't forget that even if precious metals rise significantly, they're just one tool in a broader strategy. They're not salvation. They're not a get-rich-quick scheme. They're a hedge, a diversifier, a form of insurance against specific risks. Treat them as such. We should expect institutions to respond to what's happening in Shanghai. If China is tightening delivery requirements and making it more expensive to maintain paper short positions without physical backing, other participants will adjust their strategies. Some banks may reduce their exposure to silver altogether. Some may shift to different hedging strategies. Some may actually increase physical holdings to back their obligations. Western exchanges may face pressure to follow Shanghai's lead or risk losing credibility. If participants believe Chinese markets offer better price discovery tied to physical reality, capital could flow east. This is already happening in other commodity markets. The Shanghai Gold Exchange has become increasingly important for price discovery. The petroyuan, where China settles oil trades in yuan, backed by the ability to convert to gold, represents an alternative to the petrodollar system. Silver is smaller and less systemically important than gold or oil, but the same forces are at work. As Western financial systems face stress from debt, deficits, and currency concerns, Eastern markets are building alternatives. They're creating infrastructure that ties paper contracts more closely to physical delivery. They're accumulating real assets. This doesn't mean the West loses control overnight. It means the multipolar world we're entering has different price discovery mechanisms, different centers of liquidity, different rules. Investors who understand this shift early have an advantage, not because they can predict exactly how it plays out, but because they can position for a range of outcomes rather than assuming current structures persist forever. We haven't talked enough about the industrial side of silver's equation. Solar panels use silver. Every panel requires roughly 20 grams. As solar adoption accelerates globally, that's tens of millions of ounces annually and growing. Electric vehicles use silver, more than traditional cars, in wiring, in electronics, and various components. As EV adoption grows, silver demand grows with it. Electronics, medical devices, water purification, even certain AI infrastructure components use silver. It's the most conductive metal, it's antimicrobial, it's irreplaceable in many applications. Here's the critical point. Industrial users can't easily reduce consumption when prices rise. They need the metal for production. They can't substitute effectively for many applications. They have to pay the prevailing price or stop manufacturing. This creates inelastic demand that investment demand sits on top of. When both sources of demand are strong simultaneously, available supply can tighten quickly. The industrial story alone doesn't explain Shanghai's move, but combined with monetary concerns, with central bank policies, with currency dynamics, with the paper-to-physical disconnect, it adds up to something significant. This is why silver isn't just a monetary play. It's not just gold's little brother. It has its own unique characteristics that can create explosive price action when conditions align. We may be approaching one of those moments. Let's address expectations directly. If you're looking at this situation hoping for quick profits, you're likely to be disappointed. Markets don't care about your timeline. They move when they move. What Shanghai has done might be the beginning of a multi-year shift, or it might be absorbed by the market with minimal lasting impact. We won't know for months or possibly years. This is why position sizing matters. This is why you don't bet money you need next month or next year on an uncertain outcome, however compelling the logic. The investors who do well in precious metals over time are the ones who think in cycles, who accumulate when prices are reasonable and sentiment is negative, who hold through volatility, who don't need to time tops and bottoms perfectly. They understand that the value proposition isn't about predicting next week's price. It's about recognizing when risk-reward is favorable and when underlying forces are shifting in your direction. Right now, we have a potential shift in market structure. We have ongoing monetary instability. We have growing industrial demand. We have supply constraints. We have geopolitical realignment. That doesn't guarantee anything in the short term. But it suggests that patient holders of physical silver or well-chosen silver investments have favorable odds over the medium to long term. Emphasis on patient, emphasis on well-chosen, emphasis on odds, not certainties. One of the most important things you can do right now is continue learning. Understand how futures markets work, how delivery mechanisms function, how banks hedge exposure, how central banks think about interest rates and currency stability, how supply chains operate for physical metals. The more you understand the machinery, the less you're swayed by headlines, the less you're dependent on anyone else's analysis, including mine. Read the market reports from exchanges, follow actual supply and demand data, pay attention to what industrial users are saying, watch currency markets and their relationship to commodities. This isn't about becoming a professional trader. It's about being an informed participant who understands what they own and why. Too many people in this space rely on simplified narratives. Banks are manipulating everything. The system is about to collapse. Silver is going to $1,000. Maybe those things are partially true, maybe they're not. What matters is whether you understand the actual mechanisms, whether you can separate signal from noise, whether your decisions are based on reasoning or emotion. Education is your edge in a market where most participants are driven by fear or greed. I want to emphasize this one more time because it's so critical. No matter how compelling the case for silver, no matter what happens in Shanghai or anywhere else, no matter what price does in the coming months or years, your first responsibility is to manage risk. That means diversification across asset classes. It means appropriate position sizing. It means having liquidity for emergencies. It means not betting money you can't afford to lose on volatile, speculative positions. It means accepting that you could be wrong, that markets could remain irrational, that unforeseen events could change everything. Risk management isn't pessimism, it's realism. It's the difference between surviving to fight another day and being wiped out by a single position that didn't work. The greatest investors in history didn't get there by betting everything on single outcomes. They got there by consistently making good, risk-adjusted decisions, by surviving downturns, by being positioned to take advantage of opportunities when they emerged. You should approach silver, or any investment, with the same mindset. So where does this leave us? Shanghai has changed the rules in ways that could matter. The broader context of monetary policy, currency stress, and physical supply and demand supports the case for higher silver prices over time. But over time is doing a lot of work in that sentence. And could is not will. What you do with this information depends entirely on your situation, your risk tolerance, your investment horizon, your existing exposure, your financial goals. For some, this is a signal to maintain or modestly increase silver holdings. For others, it's interesting but not actionable. For still others, it's a reminder to stay educated and watch for clearer signals. What it shouldn't be is a trigger for panic or euphoria. It shouldn't cause you to abandon your investment strategy or make decisions driven by emotion. Markets are cyclical. They move through periods of calm and volatility, optimism and fear, rationality and madness. Your job is to understand where we are in those cycles and position accordingly without overreaching. We may be at the early stages of a significant move in silver, or we may be experiencing another false start that fizzles like many before it. The beauty of proper position sizing and risk management is that you don't have to know which it is. You can be exposed to the upside while limiting your downside. You can participate without gambling. The global financial system is under stress. That's not fear-mongering. It's observable fact. Debt levels are unsustainable. Currency confidence is eroding. Central banks are trapped between inflation and financial stability. Geopolitical tensions are reshaping trade and monetary systems. In this environment, hard assets matter. Physical commodities matter. Things that exist outside the banking system and can't be created by policy decree matter. Silver is one of those things. It's been money for thousands of years. It's essential for modern technology. It's in relatively short supply. And it's showing signs of breaking free from the paper contract structures that have controlled its price. Shanghai's rule changes might be the spark, or they might be one of many catalysts that accumulate until something breaks. Either way, the underlying story remains compelling for those with patience and discipline. Stay informed. Stay rational. Manage your risk. Think long-term. Don't let emotion drive your decisions. If you already hold silver, remember why you bought it. Has that reasoning changed? If not, stay the course. If conditions evolve, be willing to adjust. If you don't hold silver but find the case compelling, take your time. Educate yourself. Start small. Build conviction through understanding, not through fear of missing out. And regardless of your position, remember that no single asset is a solution to all problems. Silver isn't salvation, it's a tool, one piece of a broader strategy for navigating uncertain times. The crisis may be here, as the title suggests, or it may still be building. But crises also create opportunities for those who've prepared, who understand what they're looking at, and who can act with clarity rather than panic. That's what separates investors from speculators. What separates wealth building from wealth destruction? Be the former, not the latter. Thank you for your time and attention.